Hey guys, welcome back to another video. I hope you guys are having a decent start to your week and hanging in there. I know that the market is really tough right now, so patience, persistence, and pre-planning are the three pillars of getting through it right now, at least for me. Now, speaking of the market, it's the middle of the month, so it's time to start looking at what is going on in the freight market as of March 2023. Now, if you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. Okay, so freight market. What in the world is going on in this industry as of March 2023? Ready? Let's go. Okay, so first things first, we always start by looking at the diesel prices. And currently we're comparing the last 3 months. These numbers are according to AAA. So currently we are at $4.34 per gallon. It dropped quite significantly from February, actually around 20 cents, according to this. Now, if we look at the Sonar gauge, we can see, according to Sonar, it's $4.39 per gallon. And we can see right here that we are at a 52-week low, which is the first time we can say this, right? This is the lowest diesel price in a year, which is wonderful. Now, if we look at the chart right here, this is the diesel truck stop actual price per gallon. We can see that it has been going down and continues to do so. And it's not going down as aggressively, I feel like, as it did in the previous few weeks, but it's still going down, which is awesome. Now let's take a look at a more detailed view by looking at the most expensive diesel states and the least expensive diesel states. So starting with the most expensive, and if you guys remember from the previous video and the one before it, I started including the IFTA tax in order to figure out what the real price is per gallon. So let's take a look. At the pump, the most expensive state is, of course, California at $5.57 per gallon. Then we have Maine, Washington, New York, and Pennsylvania. But as I said, there's also the IFTA tax that we have to consider. And if we take the price of the pump minus the IFTA tax in that state, these are the real prices. Now, in terms of real prices, the most expensive state is actually Maine, and California is number 2, followed by New York, Washington, and Pennsylvania. Now, in terms of the cheapest diesel at the pump is Oklahoma. I believe it was Oklahoma last month as well, followed by Texas, Missouri, Kansas, and Iowa. Iowa is actually new here. It wasn't here last month. Now, including the IFTA tax, the least expensive state is actually Iowa, if we take into account that IFTA tax, right? So in terms of real price, Iowa is the cheapest, Missouri is the most expensive. Basically, the West Coast and East Coast are not optimal in terms of diesel prices. They also happen to be not optimal for load prices, so just stay away from there. Now onto the freight market itself, and we're going to be looking at the volumes versus rejections. If you watch my weekly market updates and forecasts, you already know what these are. Now, if you don't, I'll explain. Volumes show us how much freight there is in the market, so how much demand there is for transportation. The tender rejection rate in white, volume is in blue by the way, in white, the tender rejection rate shows us the percentage of loads that end up on the spot market because contract carriers are refusing to haul those contract loads. It also happens to show us how many trucks there are in the market. And on top of that, it shows us which direction the spot market is going to move. If tender rejections are climbing, spot rates are going to follow. So this is looking at the past year. And of course, we can see that volumes, which started off here in March of 2022, have dropped significantly to here. Now, the tender rejection also dropped quite a bit. But the thing is, and this makes me really hopeful, tender rejections around February 15th, right here, I am hopeful that they hit their bottom, because since February 15th, tender rejections, although they have been going up and down, they have been on an upward trajectory. And that means that spot rates will follow suit. Now, does this mean that we can expect amazing spot rates? Not at all, and I'll explain why. Because tender rejections are at 3.63%, which means that only 3.63% of loads, contract freight, ends up on the spot market. During the boom of 2021, this number was around 20% or more. Now, I zoomed out again and you can see that volumes, they're actually pretty stable. I mean, yeah, they go up and down, but they're pretty stable since the beginning of the year. Now, I want to show you that exact same chart, but over the course of 5 years, and I was wrong. Tender rejections in 2021 were actually above, they were like at 27, 28%. Just to give you an idea, that's where the boom happened. Now there are less than 4%. But what I really want to show you from this 5-year overview is that volumes are actually higher than before this whole craziness happened. If we put a line through, you can see volumes are higher than in 2019 and most of 2018 right here. Now, tender rejections, on the other hand, there is a line. If you take a look, there is this white line right here. And what you can see is that tender rejection rates are at their lowest point in 5 years, with the exception of April of 2020 when everything shut down. So basically my point is this market currently is not normal. Tender rejections, even though they're going in the right direction, they're still extremely low, at the lowest point in 5 years. Now, I showed this chart last time in my last monthly update, and I think it's important to show again. It shows us the tender rejection rate by the length of haul. It gives us an idea which types of loads pay better. Is it the long ones? Is it the short one-day ones? So what we can see, long haul is 800 plus miles, and that's the blue line right here. Tweener haul is 450 miles to 800 miles, and it's this red line right here. Mid haul is 250 to 450 miles, the green line, and short haul 100 to 250 miles is the white line. So what we can see from here is the short haul, the white line, has a rejection rate on average of 4.04%, making it the highest rejection rate, which means that the rate per mile for short hauls will be much better. Now, for tweeners, which is the 450 to 800 and long haul over 800 miles, you can see that the rejection, I mean, it's pretty similar, the rejection rate. And I'm actually really happy to see this, that long haul is no longer the lowest paying, right? It doesn't have the lowest rejection rate, unlike last month. Now it's on third place, we will say. The worst paying per mile type of haul is the mid haul, 250 to 450 miles, with the rejection rate at 3.58%. So basically what this tells us is if you want to make a bigger rate per mile, you have to go for those 100 to 250 mile loads, and the worst rate per mile will be paid on those mid-haul loads of 250 to 450 miles. Finally, on to capacity data, and this is a map that is provided by Sonar. So this shows us how many trucks increased or decreased in a particular market area over the span of a month, right, since last month. And what we can see, red means that trucks have left that market area over the span of a month. Blue means they entered this market area over the span of the month. And the darker the color, the more trucks. So something that is really interesting that I did not expect at all is that the map is pretty much red. So what this shows is that a ton of trucks left a ton of market areas over the past month, and only in some spaces or in some market areas, specifically Texas, Virginia, North Carolina, all these blue spaces, this is where they kind of increased, right? Now, does this tell us that the capacity in the market is leaving for good, as in trucks are leaving the industry so there are less dispatchable trucks? Not necessarily. It could be just driver behavior. It could be that trucks are leaving or have left these, like, the northern states because of the weather, and they kind of migrated to the southern states right here. There are a ton of things that could be happening, but still this is a very interesting map because we can see that there are way more trucks that left market areas than trucks that entered market areas. Now, next week, I will be releasing a video on the macroeconomic indicators that are driving the freight industry, and in that video, we're going to take a closer look at capacity. whether trucks are leaving this market, whether they're entering this market, what's going on. But as of March 2023, I can tell you that there are still too many trucks in the market. Just a few weeks ago, my dry van was in Illinois. There were about 400 some loads posted and over 1,000 trucks. Now, of course, with this kind of spread, it's pretty much impossible to get a decent rate. And of course, brokers use that to their advantage because they understand that they do not have to rush to sell their load. There will always be a carrier who is willing to haul the freight for a cheaper price. Just on Sunday, I was doing a live and I was telling you guys that there was a load posted from Utah, from Saratoga Springs, I believe, 2,200 plus miles, for $1,000. It was not a partial, it did not require a box truck, it required a 53-foot van. That was about 44 cents per mile. And if you think that that load is still on the load board, it is not. I'm still hoping that it wasn't booked by someone, but rather either canceled or postponed, but I highly doubt it. The point is that load is no longer available, despite the fact that it was paying around 44 cents per mile. Anyway, guys, I hope you found this video helpful. I hope that you learned something for yourself. As I said in the beginning, patience, persistence, and pre-planning are very important right now. Even me, I never pre-book loads. I started pre-booking loads because sometimes I manage to get a higher price that way. Wishing you all a lovely rest of your week, and I'll see you in the next video.